Today's webinar is on the topic of profit optimization, margin kind of focused, margin-based marketing for e-commerce specifically. It's a topic that obviously is very relevant for a lot of e-commerce brands now, given the fact that we're in economically uncertain times, budgets are tight, and yet there's a need to deliver results. So in the kind of previous era of marketing, there was a lot of focus on top line revenue growth, and now companies are much more mindful of how to actually maximize the bottom line. And we've done a podcast on this as well that you can check out. But now we're gonna go into some more specifics. Or my colleague Christopher is gonna go into the specifics of how you can actually go about doing this. So if you want to say a couple of words about yourself, Christopher.
Yes. I worked at Genero since 2014, all the time within growth hacking and growth marketing, and worked with different kind of clients, everything from B2B to B2C e-com and so on, and more focused towards e-com the past years as well. And been working with both the revenue focused ones and as well as like more margin focused companies as well, and also been through the same type of situations some of you have been like with the past years, where we have had to like look into our businesses and maybe pivoting and shifting focus and so on due to COVID and so on. Yes. I don't know, can you see me as well? Is my camera actually working?
I can see us at least.
Okay. Okay, good.
Seems like it's working.
Okay, great. Anyway.
Oh, sorry, go ahead.
Let's see here. Yes. Juuso was already talking a little bit about Genero. So digital growth marketing partner in the Nordic, been around for many years now, and we are around like 125 experts at Genero, everything from working with the strategic part to content and creatives to tech and experience, including websites and design and so on, and as well as growth hacking, and that for everything from B2C to B2B and e-com. And as you might have seen as you signed up, this webinar is for marketers and executives or decision makers, and it's going to be like a bit of like inspirational session, but also like with useful concepts with practical application as well, and a bit into how applying these things into your marketing. And feel free to use the chat to ask any questions during this hour, and we're going to end with a Q&A as well, where we're going to go through any questions, and you can ask more if you would like to. And we are also recording it, so you can also revisit it during or after the webinar as well. So as an example, it's been repeatedly shown that companies that maintain advertising efforts during like a recession experience like a strong recovery afterwards. And it doesn't apply to just recessions. It can apply to like the COVID situation or what we are experiencing maybe today that we're going into and having the inflation going on. For some companies, it might be a hard time, and that's where like this margin thing becomes like a topic that's many wants to listen to and talk about at the moment, and think a little bit more about. Here is an example where you can see the blue line. This is during like when COVID hit, and it's like within like a market that got pretty affected of it, and how the market changed and dropped. Above though the blue line, you see a company that continued to invest in the right kind of way, sort of decided on where to put the focus. And you can also see when it's done in the right way, you get out of the period much stronger as well than the market. You can see before the dip, it's actually in line with the market mostly, and then it goes out even stronger. There's also one example. If you haven't heard, we have a podcast as well, the Launch Pod, that you can find on Spotify and as well watch on YouTube or listen to. So there's an example of Photonom as well, that is a similar thing, like where the market drops and how they invested in marketing during that period to come out stronger afterwards. So the smart thing usually during these times is to invest in the right way, and then it's the question, what is the right way then to invest? And it varies, but like what we're gonna focus a bit more on is margin-focused marketing today then, which is then like a more strategic approach, where we start to look more into maximizing the profit by prioritizing the products and services and what we are doing, and optimizing the marketing efforts to increase the margin in what we are doing. So it involves like the analyzing part and analyzing the products, markets, and so on. Think about the cost structure and understanding the willingness to pay for the products as well, and actually understanding the consumer in the situation, and in all this, like, identify the opportunities, either maybe increase the prices or reduce costs as well, but without losing customers. So we have some keywords from that. This prioritization, product, services, and so on. And we're gonna go into more of those during this hour. And why we care about it is because it's a sustainable way of working, sort of. It maintains financial stability, and we respond to market challenges and changes, and it creates an opportunity to differentiate ourselves on the market, creating more value. And that's what we're gonna look into, how to add more value in all what we are doing today. So we're gonna go through 3 areas, and the first one is analyze, to understand the market and identify opportunities. And the second one is prioritizing products and services. So what products and brands should we focus on, and how do we turn pricing into a competitive advantage? And then, like, optimizing marketing efforts as well. So we're gonna go through some practical examples of how bringing in marketing into your advertising, for example. So let's jump into analyze. And here is sort of like the basics of KPIs. So you need visitors, and you have a conversion rate, and you have an average order value, and you have a repeat rate, and that's the revenue that you bring in, and then you have the costs, and then that is left with the profit. And usually when looking at KPIs, as more high relevant KPIs you're looking to, the more complex it becomes, and it becomes more hard to measure. And that's maybe also a reason why not everyone has been or been able to go there, to actually look at customer lifetime value. And even the CPA becomes more complex, because you need to know what the CPA should be compared to just measuring ad impressions or clicks or whatever. And how it maybe usually looks is something like this. So you have the acquisition part where you measure the revenue, and you have like ROAS, or customer acquisition cost, as the KPIs. And then you have loyalty, and you maybe look at lifetime value. But what I would think about and challenge is to how to look at this, and where margin, ROAS, or like AMER, which stands for marketing efficiency ratio. So acquisition marketing efficiency ratio in that sense. And then for repurchase, start thinking maybe about something like a cash multiplier instead. And we're gonna go into this in more depth now. So if we have those, and then if we then start to look at the big picture of the company, we start to look at blended MER. So marketing efficient ratio for the whole thing. What do we pay for things, like for the marketing and advertising, and what do we get out? And in that way, we get to understand the big picture, like how the whole business actually going in terms of return. And then, as we see today, attributions and so on becomes more complex. So we need some kind of KPI like that to lead us in the right direction in the big picture. So looking at the marketing efficiency ratio is equal to like that you take the total revenue, as I mentioned, and you divide it by the total ad spend, and that's it. So it's pretty straightforward. And let's see there. And as we go into the second one, the cash multiplier, it's a KPI for you to think about due to the reason that lifetime value is really hard to measure. It could be like you could have customers for a very long time, and if they stay for months or like even years, then it's too slow to measure it. You won't see like the return it actually brings what you're paying in short term. So what cash multiplier is that you sort of look at something similar to lifetime value, but over a shorter time period, and it would vary business to business. But if you look at like what do a customer bring in 30 or 60 or 90 or even 120 days, what is the actual value there? And if we have that one, we can react faster in what we are doing. We can even test advertising campaigns and see what kind of campaigns or advertising is actually bringing up or cash multiplier and lifetime value sort of in that sense. And we can launch something, we can see that something is promising, but then it dips over time. So we're gonna go into some examples here, and let's start with like subscription-based e-com then. So let's say you have a baseline where you're usually at. So you have the line here, and if we run a campaign with like a 20% discount on your first order, you can see then like in a shorter term, if these are weeks down here, we can faster see if it aligns with our baseline or what we want to improve. And the same goes with like if we offer like 1 month free or 1 year with 10% discount, how would that develop? And we can like easily find a winner and definitely losers as well in the development. So, and with the help of this, we can also identify what are we actually willing to pay for a customer at the same time. So what is the value it would bring in to our business more short term than in a few years. And we could also try it or test things with it by looking at the products that we are selling and what could be the entrance product that we are pushing for. Is it like a start with test kit that we are trying to sell in the beginning, or is it like a start with a larger package that we try to create a high average order value from the beginning, or is it like a discount product that we are trying to sell? And we can start to react pretty fast and see like, okay, we shouldn't push these kind of products, or we should push these instead. And we start with this one, and then we upsell these products and so on. So you can create like pretty good funnels then to increase your cash multiplier and lifetime value of your customers in that sense. So going in to prioritizing products or services, there are of course many factors to look into when it comes to those things, and we have all the costs and the sales price and volumes and overhead expenses and all that, like the whole business itself to actually understand or look into to understand what price levels we need to be at and so on. But then we also have the impact of inflation and economic factors. And that is what we're going to look a little bit more into today, which is something useful for multiple or different kind of companies. Here you see a table from when right after COVID hit, and how the watches market developed and was predicted to continue to develop afterwards. So the market just dropped. This is for Sweden, and it dropped to the level of 2013. So it looked pretty bad. And if just looking at this, the whole market for selling watches, it looks really bad. But if we start to think about it, people started to stay home, and we didn't need like a Rolex or anything anymore because we weren't out. It wasn't like we didn't have to show off any products like that. Instead, people started to buy monitors instead and smartwatches because people started to exercise and so on. So if we started to dig into the product categories and the specific products and brands, we started to see different behaviors and different developments, and decrease in sales on some categories, but increase in others. And there we could start to pivot what products we tried to focus on, what brands we started to buy in, and what we focus, like what we tried to advertise and market. And similar things happen in other markets. And if we take like fashion, we started to see where brands also started to have a negative development. Many like similar thing, we didn't go out as much. We started to look into clothing that we could wear at home, maybe during a lockdown or something like that. So we saw the same kind of development there. But if starting to dig into it, it didn't need to mean that like a whole brand needed to go down, like downhill. It could be product categories within those brands. And if we start to look, now actually this is in Swinglish almost, it's Swedish words and English here. But if we started to look at like product categories themselves, so of course like people didn't need blazers and suits and so on anymore, but they needed other things. So jumpers and like loungewear and pants and so on. And that means that we can then pivot everything that we are doing a little bit according to that. Of course, it can be hard to buy in new brands and products in a short time period, but we can look at what we have and how we put prices on our products to sell the things, and as well like what we are promoting extra and what we are putting time and effort in to focus on. So even if we go into search engine optimization, we can start to think about like what kind of pages and keywords do we actually need to put our time and effort into optimizing going forward, but at the same time taking it into account long term. And that goes then back into what we looked at earlier and start to look into the products and what we are selling and what can bring this cash multiplier further. And there is ways to automate this as well. So if we start to look at advertising, and if we take Google Ads as an example of channel, the usual thing companies do is that they are pushing, like when a purchase happens, there is revenue coming in, and the revenue is pushed to Google Ads as the conversion value. That's the basic setup that you do. But if we start to think about it, and what would actually be better to do is to, when a purchase happened, the revenue comes in, we start to take into account the cost of selling those products. So we get the margin out of that, and we push that as the conversion value for a advertising platform. And it varies how easy it is to set it up, and it depends on what data sort of you have in your systems and how to get them in. But you could easily like create in a Google Tag Manager, you can create scripts to do the calculations for you, and in that way send the right kind of conversion value to the advertising platforms. And then what you could start to think about is, well, then we will get like less conversion value pushed to Google Ads, and would that affect the data that we get in? But that's not the case, because we are still getting the purchase or transaction events as well. So we get the volume of events, but the conversion value will instead be margin, which will still support like a growth path, but a more sustainable growth, because you would instead put like ROAS levels on your advertising that aligns with what you're actually willing to pay for the margin that you're getting out. So excluding like all the other costs, you just need to take into account what kind of advertising spend you have to calculate the ROAS. And yeah, so pretty straightforward to do that, and pretty easy when looking at it. But then it's the system that needs to have the data. If it can come straight from the website, or another system needs to feed the data somewhere, for Google Tag Manager, for example. And then that leads then into optimizing marketing efforts. So if using cash multiplier and the blended MER on channel level, we can easily start to see like the effect on channel levels as well. So we can start to see like what channels to actually bring short-term versus like long-term revenue, and what can we actually, where should we put our time and effort, including like non-paid channels as well. So utilizing data to segment your advertising and find opportunity improvement. So use this kind of data to figure out what channels actually to use now long term. And as well, jumping back to this part, we could even take it to the next level when we go into how we do the advertising, like how we set up the structure of the account then. If sticking to like Google Ads as an example, one basic way of the first very basic level of setting up like shopping or PMax is that you have one campaign and that's it. But it's not really controllable. And if looking at Performance Max and PMax in Google Ads today, there are not too many ways to control what it's actually doing, sort of. With the more of the automation coming to it, it becomes like limitations in what we can control and optimize, because it's based on that the algorithm or the machine learning will figure out who it should target and price levels and so on to put on it. So what we can do then instead is to control what data Google Ads in this example gets. So we can, as we were thinking about margin before, we can also then start to think about either revenue level is the basic one to do, but then even margin level on this one as well. We could start pull data from the different sources. So the sales data that we have, the advertising data, the spend we have on different products, categories, and so on. And we can combine that data and start segmenting products. And that whole thing needs to happen somewhere. So it could either happen like in a sheet or it could happen in a tool. But what we need to do is to find products that are like high performers or low performers, etc., and figure out like a way to segment them, which we will go into further, so we can push the right products in the right time, and in that way control these automated advertising like Performance Max in a better way, to tell the machine learning what to push when, for what kind of ROAS levels, and so on. Because it's most likely not so that you have the same kind of margin on all the shoes that you're selling in the store or whatever products, but you have different margins depending on brands, or if you even have like sales on some of the products, the margin will decrease. So what this then helps is that we can push, we can show ads based on that, instead of just believing that all shoes would perform the same way. So here is one way to do the segmentation then. And if looking at your product portfolio, you will have like top performing products. Those those will stand for the majority of what is generated through the advertising. It could be like 10% that stands for like 80% of your revenue or something like that. Pretty big part. And then we have the costly one, the red ones in this graph. And those are most likely spending a lot of your budget, but they are underperforming and doesn't really bring money to your business. So there we're gonna try to save money because we are losing money on them. We have all the other products, which is a big majority of all the products that we do have, and these we are gonna try to like make better or make sure they are like performing, moving into the top level. And then we always will have like these zero cost or sleepy ones. And these products, the machine learning or the advertising platform is sort of unsure about advertising them, so they will maybe not be advertised. It won't try them out. So we need to push the machine learning algorithm to try them out a little bit more. So we're gonna go further into that. So what will happen is that product by automation, they will move around between these blocks. Costly might become profitable because we control the ROAS on those kind of products. They've been unprofitable, but we're making them more profitable. And some of these like other products will not perform well and become costly, and then they end up in a process where we try to get them profitable. And in the same way, it works into the top level, that we're trying to build more products that become profitable with the right kind of ROAS targeting and so on. And the costly, the zero cost and sleepy products start to be advertised and hopefully generating margin for us. And the budget allocation you start to control then, so you put more budget towards the top performing ones and a little bit less to the all other ones then, and then the costly get less, and then you have a budget that you let the sleepy ones to be tried out with. And this could be then revenue based as the first step, but then you can even go into margin based if you have that data, and then you get even further control of the business. And then we have branding in advertising, and branding has like a huge role in the end, even if we are very performance focused from time to time. Branding has a huge impact short term as well as long term, and during a time where we need to figure out the margin more, the branding can help us, of course, to make our products and services look better and create more value. If we need to have higher prices, we have a reason for it because we have a better brand, and it helps us increase customer loyalty and in the end also reduce acquisition costs of new customers, both short and long term. And it's about emotionals in the end, to get the feeling of the brand and product sold. And what happens as well is that if we still continue to focus on the branding, which shouldn't be left out, it makes it much harder for the competitors to compete, because as the market is changing, you most likely heard about like that companies are like maybe not advertising as much as before on some platforms and in specific segments or industries. But at the same time, there is less demand, so we're still in the same kind of situation as before. So what is good to do for some companies at this time then is to revisiting the branding a little bit and think about if something has changed now. So we have our unique value proposition, and what does our company do, and like that nobody else does. Has that changed now when we have looked at the data and what we're selling and pushing and what we're focusing on? So is it different today than it was like a year ago? And the core products, if the data has shown that something else, that we should focus on other kind of products or in a different angle, has that changed today then? Is that something we need to take into account in the way we communicate in the ad or positioning when we do the advertising to build the brand and get new customers? And we need to revisit our unique selling propositions as well. So why do the people buy your products? Is it different today? Most likely there are some new variables to take into account, especially about thinking about the money people have today and how they are thinking about their own financials. And maybe we saw in the data earlier that, and when we analyze our products and margins and portfolio, are the product different that we should focus on? For example, during COVID and the watch market, we should change a little bit our communication towards the smartwatches and monitors rather than talking about the luxury brands. And what does it do for the people? Well, like, what are the benefits? And here comes the cost thing, of course, but also other things, and thinking about the brand and what can create this like extra value for our brand and products in this time then. Because many people might start to think about like buying like more quality rather than quantity as well. So that's something to take into account and think about. And how has the market changed? Are there other products, less products, the competitors? We can see like some companies are changing, some companies stop to exist maybe, and so on. So the landscape might be changing as well, and valuations are changing and everything like that. So like it's good to revisit that for some of the companies. And that also then leads into the customers. And what are the ideal customers today? Because if we have had a product portfolio where we had like cheap, mediocre, and high-priced products, is it still working? Are like the customer segments changing? What are actually profitable and good customers at the moment? And going back to the cash multiplier as well, and the lifetime value. Where can we see the lifetime value today coming in? And maybe the problems that they need to solve has changed as well, and that they currently have. Is it the payment? Is it like, are you selling cars? Maybe it's that you try to cut the cost, so you can maybe offer like also the insurances with the cut cost. Like you can think about like many different levels on that as well. And then of course, like what's the end feeling with the product? And maybe now people are thinking twice about some purchases. So what are like actually holding them back from making the purchase as well? And that we need to take into account then as well when we create or like communication plan towards our customers, and what kind of content we are testing, what creatives and so on. How do we visualize things? And how do we solve their problems then in the end? So to sum up, there's like a lot of things to look into. This was like a more inspirational like session in a way, with some concrete examples, and we can spend days to look into all things that could be done. But we have all these areas that are, it's pretty like simple to start look into the margins and the cash multiplier and Mera and so on. And it's pretty straightforward to start analyzing it based on it. Of course, for like that, you also need like a system that you can follow up on how like customers have developed over time and so on. But if not, maybe that's something to start to look into and see if it's possible to solve in your business, so that you can follow up on the lifetime value. The advertising parts, you can do like the structure of Google Ads, for example, today with revenue even, and then you can figure out the margin thing and try that out. If it's more technical and challenging to solve in a way. And yeah, it's pretty straightforward to revisit the communication and the branding in a way. So and this is nothing new in a way. This is something we can always do. We can always focus on margin because it supports like a sustainable growth, even if we are growth focused. So that's what I had today, and now it's time for Q&A.
I think it was a really very information packed 35 minutes. So thanks a lot, Christopher. And I agree with what you said, that these are really good things to think about, even in good times, regardless of the changes or like the circumstances in the market. But of course, especially important to think about now. And you highlighted a lot of very specific, concrete things that people can take away and implement quite easily, that would hopefully have a quite noticeable impact on their margins and profitability. So yeah, if you have any questions regarding the presentation or anything else on the topic of profitability, e-commerce marketing in 2023, you can ask them in the chat. I have just a question for myself. How do you think about? Do you think most companies should be looking? How do you think about like first order profitability versus reaching break even with like the cash, like the 90-day LTV, like within a 90-day time frame, or having to look at like a longer time frame? Do you think most companies really aim for being profitable or reaching break even on the first order? Should they be more thinking about the 90 days or even longer?
Yeah, I think it varies a lot depending on the business. If it's like a one-time buy product that you're selling, sort of, then of course you need to look at the first purchase, because you might not get like any repurchases, sort of, if that's not possible. And then we have like other companies. If we take the subscription example as was there, like you might not do good business during the first weeks, maybe of a subscription base, because it's about volume, sort of, as well. So then you're most likely not gonna make margin in the first purchase, but look at it more long term, and maybe in like 90 days, what it brings, sort of. And then we have everything between there, sort of. And also, I think it also depends a bit on where you see yourself going at the same time. Even if it's like a subscription based, you could focus on getting good margin early. But if you want to get up to a high level and high volumes, which maybe cut costs for you because you get more quantity of sales, which lowers your production costs maybe, then you can do it more aggressively to long term, like make much more profit, rather than thinking small and do less margin for the business. So yeah, it's a bit of a calculation there to figure out the level,
For sure.
but it's pretty doable most often and relatively straightforward.
Yeah. So you will ask, how can churn rate be calculated in LTV cash multiplier in an efficient way?
Yes. Yeah, so churn rate, it's sort of part then of like the multiplier in a way, because we're gonna look at it like in on a bigger scale. Like we're not gonna look at a single person in a way. So if having like if we take the subscription again, you will have churn from day one, I would gonna say, but like pretty early. But you're gonna look at like maybe longer term, let's say 6 weeks then as an example, and then you get like the churn is calculated within that. Like say you have 10 customers, 3 churn, and then you get like an average of what the value of 10 customers brings in 6 weeks, for example. So that's how it would be added into that. So churn is sort of like a secondary KPI there within it.
And Alexandra asks, for testing products, when would be the right time to stop selling a product that just doesn't sell, or could there be any other perspectives or tools that apply?
Yeah. So if you have a lot of stock of the product, you most likely want to get rid of the stock, right? So then that would maybe be a focus to not get some money out of those in some way. One way could be to think about it as the structure we looked at, where we have the costly ones, and try to figure out like a way to get something out of them, a margin out of them, or if it's better to just get the money to sort of break even on them or something. And yeah, the right time, it depends then, of course. You could ask more questions if you want, but like of course, like if you're thinking about like a new product as well, if launching a new product to evaluate it, if it's good or not, then you would need to set like a level of what is like a proof of if it's not working or not, like like how much are you willing to spend to try out the product, sort of.
I would add to that obviously, like you said, Christopher, if this is a new product that you brought to market,
Yeah.
then you need to give it enough time.
Yeah.
But if it's a product that's already in your portfolio, and especially if it's not if it's a typical kind of product, and you're seeing that, well, there's clearly no demand for this, then I wouldn't be afraid to remove it if it's not selling, because we really, I think, often underestimate how simplifying things can have such a huge impact on the efficiency of everything. Like the more products we have, the more friction we can create for customers, and the more also complexity we create for ourselves with logistics, with marketing, with everything. And so if there's something that isn't bringing in revenue, then removing it from the mix makes everything simple. It simplifies everything, and that typically improves performance. So I wouldn't be afraid to cut out non-performing products from the portfolio. Any other questions? Feel free to add them in the chat. I have a question regarding kind of using blended MER as a guardrail, or as some kind of guideline when it comes to marketing and thinking about marketing spend. Do you have any recommendations? Obviously, it's going to depend from company to company, but do you have any recommendations as to what that level should be, and how should you go about determining what the appropriate blended MER should be for your company?
yeah, if we take the costs and everything, then it would be like that. We have a margin that we need for the business, right? To either sustain or like grow, whatever we are aiming for. So then we have what we would need to get out of the volume that we are actually selling, to cover the costs and reaching our financial results that we have budgeted or are reaching for. So in that way it varies.
Mhm.
And if you are like a company that's like a company which stays like on a certain level, like let's say you have 30 million in revenue and you're happy with that, and that's it, then it's maybe more, if you maybe are focusing on getting more margin out there from that business, then you want to increase that mer blended mer. But if you are like more growth focused, maybe more accepting that you have a lower profitability in the business, rather than go for like the volume and take market share in a way, and maybe thinking more long term about getting the EBITDA to the right
Mm.
level, maybe then it would be lower percentage. So yeah, in the end, I would look at the business strategy and the
Yeah,
actual budget of the company to
yeah.
figure it out. Maybe if I would go all the way on it, uh,
Mm.
and have a look.
I mean, it needs to be high enough so that you don't go bankrupt.
Yeah,
And
exactly.
but I think also there's a risk of anchoring to the past. Like the MER you had in 2020, 2021, 2022 may not be the MER that you can achieve this year.
Yeah,
And so
exactly.
there's yeah, and there's a risk for companies to think like, well, we're not seeing the MER that we want to see in our budget, so we're just gonna pull down on ad spend and kind of wait it out.
Hmm.
And that can work, but there's also risk. And the risk is that we've seen generally increasing acquisition costs. So you may not like your acquisition cost today, but it might be the lowest acquisition cost that your business is going to see.
Yeah,
And so not spending, not actively marketing, not actively acquiring customers is also a choice. And it carries its risks with it. Um, so I think companies need to be mindful of when you think about those targets. MER is not a target that you should set unreasonably high, because that's going to limit your growth
hmm,
potential. Like you need to be realistic.
exactly. Yeah, yeah, and if going for that approach that you sort of stop doing what you're doing, sort of, there is like a relatively high risk depending on the business, of course, but long term you will start to lose those loyal customers. Like loyal customer is one part, but you need the new customers as well, most likely. So if stop doing any acquisitions, it can backfire a bit more long term, in a way.
Yeah,
um,
that's it.
and like always, like even if it's hard times, there's always opportunities. Sort of, there are challenges today, but there's also opportunities on the markets, in the end. So yeah, as we saw, like in the beginning, there like a graph of the market and like how one company kept investing and got out of it even stronger than others, taking market share during that time period, keeping the brand awareness high or getting it even higher because less people are advertising. Um, so yeah, really need to think about about the long term, what you want to get out of it all.
Absolutely. And I think to kind of summarize, I think what you've been talking about, one way or one important takeaway is that marketing needs to be very informed by business strategy and the actual like the financials of the business, whether it's your cash flow, your margins on the product, and marketing can't just be a separate thing that just does its own thing and has its own completely different metrics. It needs to be very much informed by everything that's happening in the business.
Exactly.
Okay, I think there doesn't seem to have any. We don't seem to have any more questions coming in the chat. So, yeah, thanks everyone. Well, first of all, thank you, Christopher, for hosting this webinar. Thanks to everyone who joined us. You're gonna get an email with a link to the recording, so you can watch it after if you like, or share it with colleagues and friends and family. And yeah, if you have any further questions on this topic, anything that you thought was interesting and want to discuss more, then you can reach out to us via our website. You can contact Christopher directly on via email or LinkedIn or something, and yeah, we'd be happy to continue the conversation.
Yeah. Perfect.
All right.
Thanks.
Thanks, everyone.
Thanks, everyone.
Take care.
Take care.